Welcome to the MUFG Global Markets FX Week Ahead podcast with Derek Halpenny, Head of Research, Global Markets EMEA and International Securities. It's Monday, 26th April 2021, and in our preview of the week, we're discussing the major themes for the FX financial markets. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only. Good morning, Derek. And what should we be looking out for this week?
Good morning, Una. We're into the final week of April. So, we can often get unusual month-end flows and often they're not really attached to fundamentals. So that's worth remembering when we have these podcasts and we talk about the fundamental outlook. And you're in this week when certainly Thursday, Friday, you can have these unusual moves. But the clear event for the week is absolutely the FOMC meeting on Wednesday. Obviously, we've had this correction in 10-year yields from the highs at the end of March. So that's opened up the scope for this renewed US dollar weakness that's been with us through much of the month. And in that regard, obviously, the Fed meeting on Wednesday is very, very important. Going into the meeting, we've had two recent opportunities to hear from Fed Chair Powell, a 60 Minutes TV interview, and then in Washington when he spoke to the Economics Club. And on the TV interview, he spoke about the US economy being at an inflection point. So that's a very clear acknowledgement that we're now right in the midst of about to get some really pretty stellar economic data over the coming months. And certainly I think that 80 plus basis point move in the 10-year in Q1 was very much in anticipation of what's coming in Q2. So I think that's important. But perhaps more important for Wednesday is the comments made at the Economics Club. And there was a shift in possible strategy in terms of what we get from the Fed in terms of communication going forward. And up until now, it's been very much about, QE tapering and the timing of QE tapering being, a considerable time away. And the economy needs to rebound notably before we get to a point to start to taper QE. But I think the Fed obviously anticipate, given what's coming, now that we're at this inflection point in terms of the rebound and growth, that they need to move away from that strategy because it's pretty soon it's going to start lacking credibility. And instead now it's about the sequencing of monetary policy and the emphasis on the fact that once tapering begins, it'll be well beyond that point before we get the first rate increase. So I think the strategy might be shifting to guidance on rates rather than guidance on tapering. And that will be the greater emphasis. And that is, of course, a realization that tapering is, it's not imminent, but it's on the horizon, perhaps. And therefore, it's more important to have rates remaining anchored as tapering begins. And therefore, we've had this kind of shift in emphasis that was on show when Powell spoke in Washington. So I would imagine we're going to get more of that on Wednesday. And therefore, Wednesday is important because, if he pulls it off, and I think there's no reason to think he won't because he's already spoken about this in Washington. If he repeats it and pulls it off again in the press conference on Wednesday and rates remain well anchored, well, then it's job done. And the emphasis on the specifics on when tapering begins is kind of diluted to a degree, and we're moving more towards the timing on rates coming well beyond that point of tapering. And that will be an important shift in strategy done successfully. And I think that then leaves us open for rates remaining in a kind of an equilibrium trading range type environment that we're in at the moment. And that then allows for the US dollar to remain on a weaker footing. So I think that's crucial. Now, the scope for being cautious is still there, of course, because if we look at the forecasts from the Fed, the message is very clear. The stimulus that's hitting the economy now is transitory. So we have 6.4% GDP growth this year, falling to 2.2% in 2023, a little bit above the long-term average or the long-term equilibrium growth rate of 1.8%. So the transitory nature of growth means that there's a very much transitory nature to CPI and inflation and the core PCE index. And that is barely above 2%. If anything, you could argue that the inflation projections from the Fed are not meeting their new goal of having inflation for a considerable period for a period of time above the 2% to get the average of 2% over time. So that, I think, is the justification for the communication on Wednesday still being quite cautious in terms of the reversing of monetary stimulus. So yeah, I'm pretty confident Powell can do a good job, and if that's the case, then I think the dollar can remain, as I said, on a weaker footing, and potentially weaken a little bit further.
And is there anything else we should look out for this week, Derek?
Again, part of our dollar bearish view, as regular listeners will know, is the optimism globally resulting in increased demand for non-dollars as investments broaden out globally. And, I'm still confident of that, but we do need to be mindful, obviously, of COVID still, because on a global COVID infection rate, we're hitting new records each day. So that's a worry, of course. And if that was to continue, it would certainly start to hit the emerging market space more notably. That brings a bit of a dollar bid back, and that could broaden out, and then we could get another leg of US dollar strength. So I think that's what really needs to be watched. Now, it's obviously terrible what's happening in India, and that really is the catalyst for this global record levels of infections. The good news amongst that terrible news for India is that if you exclude India from the global infection data, the rate of infections excluding India has started to come down. And since the 14th of April, we've had, Since the 14th of April, we've had a 12% drop in COVID infections excluding India. And indeed, the global record rate that we have at the moment, 40% of that global infection rate is India alone. So while it's appallingly bad for India, the global picture is improving somewhat. And if that continues, I think that will certainly help sentiment and keep alive that prospect for a broadening of the optimism in terms of global growth going forward. The other factor that I think is worth watching this week is corporate earnings in the US. So we're in the midst of the corporate earnings results for Q1. We've got Apple, Tesla, Alphabet, and Microsoft all reporting this week. The big players in the S&P 500, of course, and that will be key, I think, for the direction of the equity markets in the US. To date, 25% of companies have reported according to FactSet data, and as of Friday, 77% of companies have reported a positive revenue surprise, and 84% have reported a positive earnings surprise. So it's only 25% of reports, but so far so good. If we get a repetition of that in these big releases this week, that would certainly be supportive for the US equity markets, and generally then, of course, risk appetite, which would be supportive of our view in terms of the dollar remaining weaker.
And then finally, Derek, what trade ideas are your research desk highlighting this week?
We haven't put on any new trades, but we have maintained the trade ideas that we've had in place. So long Aussie dollar versus the US dollar is the first trade view that we're still holding. And again, just based on what I've just been saying there, if that kind of global optimism becomes a bit more synchronized, a bit more broad-based, which I think is happening. Clearly, from when we put this trade on, we're in the money, and Aussie dollar is higher than where we put the trade on. So we still feel there's a bit more in that. And obviously, if the COVID situation globally, excluding India, continues to improve, that would also be a positive. But of course, we need to watch India as well in particular. And then even Aussie itself, I think the RBA are in a tight spot now. And the scope for them to continue being as dovish as they have been, I think, is becoming more and more limited. And I think it's inevitable that the most they can do is slow the move up in Australia dollar versus US dollar rather than push it lower. And then the other trade view is short US dollar versus the Czech koruna. So dollar Czech have been moving higher in line with the deterioration in the COVID situation in the Czech Republic. But we've seen a considerable improvement in COVID infection rates in the Czech Republic. The 7-day moving average is now down 80%, 80, since the peak on the 6th of March. And it's the lowest infection rate on a 7-day average since October of last year. So COVID situation dramatically improved there. And we're seeing that in the FX rate as well, with the Czech koruna strengthening. And again, the broad-based view, and obviously if Powell is successful with his communications on Wednesday, I think dollar Czech can continue to move lower and potentially break the lows of February at around 21.11. So maintaining those two trade ideas, both short the US dollar.
Thanks very much, Derek. Have a good week and speak to you soon.
Thanks, Una, and you.
Thank you for listening to this MUFG Global Markets podcast. Rate, review and subscribe, and reach out to your MUFG sales rep for further information. Come back next week for more insights from the Global Markets Research Team.